Hey guys, I'm going to keep this one short and sweet for you today, but lots of relevant info, so let's get into it. Bank of Canada, if you haven't heard by now, cut rates this morning. Where can I go? Let's go here. Bank of Canada cut rates this morning, so quarter point cut, nothing substantial, nothing huge in terms of that percentage change, but the big exciting news is that the Bank of Canada is continuing its cut trajectory. Okay, so second consecutive rate cut. We're here at 4.5% for the overnight rate. And why is this significant? Well, it's another indication, a further indication that we are on track for that soft landing that was so widely talked about, but a little out of reach, a little potentially unrealistic. Back in 2022 when the interest rate hike cycle began, and it was a little far-fetched to believe that we would avoid a recession and have a soft landing. Now, monetary policy has been implemented in a very strategic, very sophisticated manner to allow us this current environment. So the rate hikes worked, inflation is cooling, has continued to ease and cool, and really the only sticking point left from an inflation standpoint is in the rental sector. Month over month, we're up 0.6%. That's contributing to CPI numbers. But other than that, most of the rest of the basket impacting inflation is working its way down very effectively, very positively. So we can confidently predict a continuation of this trend with the rate cuts to come. We've got one in September, October, and December, respectively. I think we're going to end up seeing some more significant cuts in terms of percentage changes, percentage cuts as we get toward the latter half of the year, later in the year, and basically we're on pace for a very strong, very predictable 2025 and 2026. So the news is we cut rates. Why? I mentioned, here, I'll be this guy's head here. How's that work? The reason we cut rates is because inflation's continued its downward trend. All the right factors, all the right fundamentals contributing to a slowdown in the economy are there, are relevant. The reasons we've had the rate hikes, or I guess the intended outcomes of the rate hikes we've experienced are having the intended effect. They're working. Okay, so the right outcomes from the right inputs, if that makes sense. Okay, the other sticking point right now, the things that are being talked about right now, or the focus is maybe shifting. The Bank of Canada has alluded to the fact that their focus is shifting almost from inflation. They're positive about that to the unemployment numbers. Okay, and employment factors. Now, we're in the mid sixes, kind of fluctuating around the mid sixes in terms of unemployment, which again is an intended outcome of rate hikes. We know that in order to slow down the economy, we're going to see unemployment increase. It's cause and effect. So it's not out of the ordinary. It's not unpredictable. It's not a surprise. It's just a new, I guess, event or a new thing that we're going to have to tackle going forward. And to tackle that, to ease out of this, to experience that soft landing, we're now going to have to pay a little bit of attention to the employment figures, to the employment numbers. And that's another reason we're going to continue to see some rate cuts. Okay? Now, inflation numbers. Where are we here? So obviously inflation numbers is a big factor, a big reason why we've seen these interest rate cuts. Okay? 2 consecutive rate cuts. June, followed now by July. If you saw the headlines last month, you saw that inflation surprisingly ticked up from 2.7 to 2.9%. We tend to make some generalizations or react very quickly to news, right? We tend to do that. When we see these rates or these inflation numbers come out, we do overreact and we put a little too much weight to these figures, to these numbers, okay? In actuality, we knew we were going to have one more inflation announcement or inflation report before this July announcement, and kind of going into this rate announcement, going into today, the likelihood of a rate cut was very close to 100% because inflation had continued its downward trend. You're always going to see things like this in a recovering economy or a balancing in an economy, a little bit of fluttering, but we were still, nothing to be surprised about. We were still sub 3 and well on our way, well on pace to approach those 2% inflation numbers. Of course, you've heard me say it before, very interesting basket that we have in Canada where we include mortgage interest and rental figures in our CPI numbers. Really weird, if you ask me, but I mean, it's a part of the calculation. And when you remove mortgage interest inflation and rental figure inflation from our core inflation numbers, we're actually fluttering right around 2, if not just slightly below. So quite impressive stuff. Now, CPI numbers explained. I mean, you look at the impact that mortgage interest has on CPI. So you can see right there, the orange portion is the mortgage interest effect on CPI, the composition of our core inflation numbers, which is insane. If you want to read through what we've wrote here, by all means, hit the pause button and just read through this. But the big thing, I mean, is that the 2.7% reading breaks down as 1.24% mortgage interest and 1.3% for everything else. So really, when you remove mortgage interest from that basket, we're looking at inflation around 1.5%. So it's worked. It's worked. The higher interest rates are contributing to that orange portion in the graph. It's hilarious that this operates like this. It's very interesting that Canada operates like this, but it's kind of a perpetual cycle when you're increasing rates to reduce inflation, but inflation is being contributed adversely from higher interest rate costs. It's just kind of a revolving cycle. So all that really does is take a little bit longer to balance. And we're seeing it. We're seeing it happen right before our eyes from April to May to June. You can see the blue portion of the graph reducing almost steadily there, right? With the quarter basis point cuts, we're following suit with inflation numbers. Obviously, there's a lag in all things. Now, therefore, if we take out mortgage interest costs, as most countries do when calculating CPI, we end up with inflation in and around 1.4%, which is super low. Pre-pandemic levels of low, of steady, of manageable inflation, if you will. So good news. Good news all around. Sorry, this graph's a little blurry here. But you can see how impactful the rental market has been in addition to mortgage interest costs on those inflation numbers. So again, when we remove rented dwellings from the basket, you really see inflation working or trending the way it should be. Housing starts is another big one you're going to want to pay attention to. I mean, you can see here from the peak in 2020, housing starts, we're just on a steady decline. Obviously, we see a little peak there. All of the confidence and positivity in the housing market combined with super cheap costs of borrowing, you see developers and builders alike see the potential in the market and put shovels in the ground. But now we've seen a steady decline in those housing starts, and I mean that's only going to adversely affect the addition of supply in our market. Okay, so another big factor to be paying attention to, housing starts fell 9% month over month from June, which is just crazy. Okay, for us to try to maintain a balanced market, we need supply to at least keep pace with demand, and it seems to be an impossibility, at least in the GTA. Some periphery markets we definitely will eventually, or not definitely will eventually, but we have the potential to balance. In the GTA, it's just, it is an impossibility. We don't have the land with the Greenbelt, with Lake Ontario, and so forth. Labor shortages, I said, is another important factor when contributing to the Bank of Canada's key interest rate decisions. And I mean, you can kind of see the impact that, I guess, employment figures combined with labor shortages, there's just a misalignment there. We have shortages in labor, but we also have unemployment. We can, fit the pieces together. It's not rocket science. It's just math. But the unemployment figures are represented in different industries than, the skilled labor that it takes to add housing supply. There's massive labor shortages in the skilled trades sector, which again is adversely affecting supply. It's quite interesting. Job gains. So, I mean, you can kind of see 3-month change in employment. Part-time employment is working its way up, but it's the full-time. It's the mortgage payers. It's the homeowners versus the rental market that's seeing some success there. Again, you can pause this and read these numbers. I thought I would keep this under 5 minutes, but I mean, it's interesting stuff, and I could talk about this stuff for hours and hours, as you know. But this is something we're going to want to be paying attention to, and we're going to continue to be talking about going forward. Unemployment rate, I mean, I kind of touched on it. This is where we're at currently. It's unfortunately it's a means to an end, or it's a representation of the higher rates that we've seen in the market contributing to higher unemployment, slowing down the economy. Unfortunately, we need this to recover. We need this, but the jobs are there, and we're going to come out of it very, very, very simply, very easily. The jobs are there. It's just a matter of almost a mentality thing around the workforce right now, and the certain sectors, the certain, I guess, skills or qualities or degrees that are relevant in our market, and then obviously the jobs that need employment. There's a misalignment. Summary predictions. Sorry, I'm trying to fly through this here for the rest, so it's not too long. I think we're going to see a 1/4 point cut in September, followed by a 1/4 point cut in October, followed by a 1/2 point cut in December. So we're currently at 4.5 overnight rate. I think by the end of 2024, we're going to be at 3.5. This will certainly ease all this speculation and concern over the mortgage renewals that are coming up in 2025. Most of these are fixed rate mortgages. Most of these were locked in pre-pandemic into 5-year fixed rates. The retail rates that they locked into are around the 3.5 to 3.7% anyway. So, we've ridden this roller coaster of rates, and by the time the renewals are set to renew, we're going to be right at those similar, maybe slightly higher, but similar levels to what they were, or what they are now, what these mortgagees are paying. Now, wage growth has happened. We've experienced wage growth as a result of inflation and just based on employment figures. Household savings are the highest they've ever been. Canadians actually have more savings now than they have ever had, and average net worth is the highest it's ever been, which gives us a lot of confidence in our market. Okay, the money's there, the savings are there. But in terms of going forward, buyers, you're going to want to be taking advantage of kind of pricing before we see that increase throughout 25, 26. If you're thinking of buying and you have the means to speed that process up, I'd suggest that you do that. Sellers, you've kind of got an opportunity here before we see an inundation of listings to get out there anytime throughout August and early September. If you wait till September, October, which are historically seasonally better markets to sell, I think what we're going to see in this market is an inundation of listings, because just like buyers having a sense of pent-up demand to buy, waiting for rates to cut, sellers also have this pent-up desire to get sold. And, they've been holding off on listing until they can kind of get those prices that they want, or they came accustomed to, we'll call it, throughout the pandemic. We're long and far away from those numbers now. But we will approach them again. I think we're going to surpass highs toward the latter half of 2025. Buyers, get a move on. Sellers, it's either kind of right now, or, if you've got a particular asset, or you have the ability to make your house stand out a little bit, a little more unique, a little more finished product, that's what buyers seem to be looking for right now. Urgency is still not there. I think the urgency will approach back in maybe late September, early October, and there's just going to be some absorption that has to happen to get back to a balanced market. So anyway, sorry, I wanted to keep this one quick for you guys. I went closer to 15 minutes like usual. If you have questions on any of this, reach out, give me a call. Happy to chat about any of this stuff anytime, whenever you like. So have a great day, and happy house hunting or selling. We'll see you soon.